This video is going to explain a little bit about the owner finance process and how it could make sense in the future if it's something that you want to consider for a property that maybe you currently own, or maybe you're renting, or even over renting a property. Potentially look at the owner finance thing, because ultimately it can lead to a little bit better profits and a little bit less risk in certain cases. So risk tolerance is going to be the main name of the game here in this particular case. And I'm not going to go over all of the details because every single prospective owner finance deal is going to be different. It all is going to come down to the numbers, but this is kind of a process to understand those numbers to get a rough estimate of whether or not it would make sense for you. So oftentimes what we're seeing right now, at least as of April of 2026, people are trying to sell their property, but maybe haven't. And so they become accidental landlords. It is quite common in this particular instance where someone still needs to sell and or maybe hasn't been able to for any number of reasons. But they go and go ahead and rent the property. Well, ultimately, when you're renting a property, I want to see you cash flow net somewhere to about $200 to $300 a month. That is a good, healthy rental. It gives you residual income to be able to put away for incidentals. It pays for all of your service fees and things like that if you're using a property management company, which is usually recommended because when people know who the landlord is and they're blowing up your phone, it takes a lot of time. It's usually not the best idea, but sometimes it's just not possible. Sometimes the numbers just aren't there. So let's run a couple different scenarios. Now, these numbers are going to be a little bit rough because amortization schedules are just, they run a little bit differently. This is about a close estimation as I can get. So don't crucify me if you're an expert in this stuff. This is just a general overview to discuss what owner finance kind of means. So let's say you've got a conventional loan. If you've got a VA, this is going to be a little bit different. Everybody, again, a little different, but the house is maybe worth $300,000 after its resale. It's a 3-bedroom, 4-bath, something like that, or 3-bedroom, 4-bedroom. You've maybe got $250,000 of potential loan left on it. Maybe you're at about a 6.25% rate. Now this is over 30 years. Again, this is rough, but let's estimate that your monthly cost for property taxes is about $2,500 a month, which isn't that far off from current standards. So you've got your principal and interest, and you maybe have some PMI on here as well. Now this would technically be a little bit less, but this is fine for now. So that $2,500 is what we're going to call it here, is about your monthly payment, but that includes your property taxes and your insurance. Now, if you're going to rent the property, again, we want to try to get to as much cash flow as we can in order to make this asset something that's now making you money. You would have to rent this property for well over $2,500 a month in order to account for that extra cost. Right now, for a 3-bedroom, $300,000 home, 4-bedroom, they're renting for anywhere between $1,500 to $1,800, maybe to $2,000 for a nice newer one, up to, in the upper reaches of maybe $2,200 a month. Even at $2,200 a month, if the house is brand new and you put a healthy down payment down, you're still not going to be making money on that property. Let's assume right now it's $2,000 a month for easy math sake. You're still $500 in the hole that you're going to have to pay every single month in order to account for the rental. And that's a sizable amount of your income that is now taken up that you have to keep moving throughout the course of that time. Now, what happens if that renter stops making those payments? $2,500 a month, every single month starts coming out, right? Now that's kind of going to be similar to the owner finance side of things, but there's more risk from the buyer than there is from the tenant. And so those are a little bit more mitigated. And again, this is all about risk tolerance and what it is you'd be willing to do, but you're already upside down. So the question is rather than potentially renting, or let's say you have some really nice renters in the house, let's keep some of that income in our own pocket. What would it look like to owner finance the property? Well, we're going to analyze this, and primarily what you're going to look at is your P&I, your principal and interest, and your private mortgage insurance if you have any. Now, you can oftentimes get out of this. FHA, unfortunately, you cannot anymore. If it's a new loan, you have to be about 20% equity in order to get rid of the PMI. You could refinance that. That's going to throw everything out of whack. More than likely, you've got a better interest rate, so these numbers are going to fluctuate. But ultimately, look for your P&I and see if you have some private mortgage insurance. Those two are going to be your total sum. So in this particular case, we're looking at about, let's just get a more accurate number here, $1,700 a month, we'll call it. So at $1,700 a month, that is your duty to the bank. That is not negotiable. It has to go to the bank in order to keep you and your family solvent. So let's say we owner finance the deal instead of rent it. What does that look like? So generally, we want to sell this property for a bit more over current retail. Let's say current retail for the market is $300,000. We're going to sell this closer to about $325,000, depending upon if that demand is there. And then let's give about a 15% down payment. We can sometimes do more. 20% is actually quite common, but there are problems with that on the back end that I don't know if I'm going to go through in this video because this video is going to be long enough. Then we're going to give them an interest rate of about 8.5%. Anywhere between 1% to 2% is healthy. You can actually go a little bit higher, but we do need to be cognizant of the Dodd-Frank Act in order to ensure that we're not being predatory lenders. So that is something that I work my clients through, and we actually have a servicing company just like a mortgage. It looks just like a mortgage. You have a portal and everything in order to get them set up to do this, and they get paid every single month. Let's see. We don't necessarily need to worry about this right now. They've got mortgage and insurance. All right, so that brings at a $325,000 their property or their total payment to $2,983. But it's their P&I that we're really interested in. So their P&I is $2,124. Remember, we had a $1,700 payment since the last one, so that puts you at about a $410 profit because the new buyer is going to be taking over the taxes and the insurance. That's not something you have to worry about. As a landlord, when you're leasing the property, that is something you have to worry about, and you have to continually fight those taxes each year in order to get the value down, in order to keep your property taxes within reason. And yes, the taxes are almost always wrong. They don't really do real estate the way that real estate is generally done. It's all algorithms. So $400 profit versus a $400 payment or $500 payment, there's a big difference there between you actually making money. Now, the question is what are the risks? Well, there are several. The first thing to consider is that you had $250,000 still left on the loan. You would actually receive about $48,000 of that money in your equity. So you're going to receive that money. That's one of the reasons to owner finance. So now you have a cash flow, or you have actual cash coming in, and you're making money of about $400 a month. In addition, and this is where we need to be careful, there's about another $25,000 in additional equity still left in the loan. That's important because we don't want to take more down payment for more money and get really close to where that break with our current bank is, because then when the note comes due, that deficit has to be paid. Well, I hope you have the money saved up for that deficit, because if you don't, the bank's going to really wonder where it comes from. So we want to make sure there's a buffer in between there. Plus, then when the property sells or refinances out from you, you get another $25,000 on the back end. So you get that equity back out of it. So that is really kind of the cool part about it. Meanwhile, you've made $400 a month. Okay, so that all sounds well and good. This is just an arbitrary way of looking at this. What about the risks? Well, I ran through Google because that way you understand what Google is going to bring you. There is more to it than this. But the two biggest things that can happen is going to be if the buyer defaults or if the due on sale clause gets called. Let's focus on the buyer default first, because that is the most likely cause. A lot of people look at owner financing and be like, well, they're only owner financing because it's all they can do. They've got, no record. They're terrible buyers, like things like that. Not necessarily the case. There are a lot of examples of why going through owner financing versus a conventional bank is a better idea. Number one, oftentimes you can negotiate the terms a lot better. You can figure out, hey, I want to do a balloon payment on this deal. I just want to be able to get into the property for a little bit of time, and then I'll either cash you out and sell the property, or I'll refinance it. That can be kind of nice. There are reasons to do that. There's really the differences of what can be negotiated are quite extensive. But oftentimes people need to get into a property like this because they're either business owners like myself. I don't do conventional loans very well because my income is all over the place. And so oftentimes bank will look at me and be like, you're a huge risk. Absolutely not. And business owners are very similar within that same standpoint. It's hard for them to get conventional loans because we're not W-2 employees. Additionally, it can be things like divorces. A divorce can wreck a credit score and ultimately destroy your opportunity to go to a traditional bank, but you make plenty of money, and so credit was only affected because of divorce or because of something else that happened on somebody else's cause, or many other different copious reasons as to why that is. And so that's why when we run these owner finance deals, we always try to figure out how they're going to pay the property back. Do they have the means, capability, and the time in order to make these payments reliably? And again, that goes back to the Dodd-Frank Act, making that happen. So we always run it through a lender. So if you can avoid that on the front end, and you find a good qualified buyer, somebody who's interested in the house, maybe they're renting your house for a little bit of time, and they turn around, hey, I want to buy it from you. Again, let's consider this as an opportunity. It can mean a lot more income for you. And it's not something where you have to take any taxes on it now because you've been renting it for an extended period of time, where now you have to take the taxes from the sale of the property as a rental rather than a personal income property. Not something everybody always thinks about. Not a tax consultant. Go talk to somebody who's a professional about that, but it is potentially a risk. The other risk that's there is going to be the due on sale clause. Now, this is going to be if the mortgage company, for some reason, says, hey, we realize that you sold your property, which you did, and now we want you to pay us back in full. Well, where's that money going to come from? Well, the person you just put in the house probably doesn't have it. They probably don't have the means to refinance yet. So what do? Well, there's a couple different things that can happen. Number one, if all things are done properly, you can go to the bank and say, hey, well, I understand that this is what you want to do, but we're well within our means to be able to do this. We are legally allowed to sell our property. You don't own it. We do. They are separate, although banks will probably try to argue against that. But you can legally sell your property, and we can prove that the mortgage is being paid for. And we're doing it through these really professional and well done manners, through a servicer and everything like that. So let's just not worry about this right now and negotiate with the bank. Oftentimes, they don't want to go through the foreclosure process if that was the case. And so, because it costs them a ton of money, just like it would cost you a ton of money to potentially pull the property back. And so there's ways to do that. In addition, let's say the bank just decides, nope, we don't care. We're going to honor our clause. You broke our clause within our contract, and so therefore we're coming for all of our money. Okay, well, there are other ways you can do this. Now, I'm not an attorney. Always consult an attorney with matters like this. But one of the ways that I've seen this done before is through a trust. There was a situation where an investment property was purchased in a manner very similar to this. It was owner financed. And the bank came and said, hey, we want all of our money. So what they did is they turned around, they took the deed back out through a reverse deed. The attorney was quite good. Reversed the deed back to the original owner. Then they set up a trust with everyone in there as trustees to the bank. And so now it's still owned by the original owner. It's a trustee rather than a sale. And then on the back end, after everything was done, we said, hey, okay, Mr. Bank, we've got all this taken care of. We're now just trustees to this property. Therefore, due on sale clause is not necessarily a thing. And so they were able to negotiate through the attorneys to get that taken care of. Then what they did is they actually gave all the trustee power to the original owner again. Therefore, the owner owns the trust and are the chief executors of that trust. That's how that particular case was done. Every single case is a little bit different, but yes, it's a risk. It's also a pretty low risk. I think if you were to do the research and dig into it, very, very few of these get called. And we're seeing more and more of these kinds of things pop up because it's just the only option for people in certain cases in order for it to make sense to be able to sell the property. And so ultimately, if the bank wants to be a total jerk about it, yes, that's a risk that you're going to have. But it's, again, on the lower side versus renting the property. You have a $500 deficit that you're going to have to pay each month. That's a significant risk and a known risk. And then when you sell the property, after they get done with it, and you try to turn around and sell it back to the open market, you're probably almost inevitably going to have to pay for normal wear and tear type of items. If there's any carpet in the house, that's going to have to be fixed. Any paint repairs are going to have to be fixed. You're going to have to get the property back up into show ready status because condition is king. And that takes anywhere between $10,000 to $20,000 to do, especially to do it to the level at which you need to do it. Now you can always sell it for a lot less, but then you're leaving money on the table. Are you prepared financially to have that $10,000 to $20,000? Well, if you've been paying $500 a month, maybe not. So that's why the owner financing is something that should be considered and looked at, but it's not something that agents talk about often enough, primarily because they're just not super familiar with it. So this is just the nuts and bolts of some of that stuff. There's so much more to go into, and every deal is a little bit different. So I highly advise you reach out to us if it's something that you'd be considerate of. But ultimately, that's what we do. We try to think, what are the best scenarios for you to be able to accomplish your goals that limit your risk, that ultimately improve your life, that you don't have to pay taxes on the property on the back end. You're just going to pay property taxes or taxes on the $500 a month or $400 a month. And even then, there are ways to potentially pull that out and do different stuff with it so that you're not paying anything on it or paying a lot less. So just something to think about, and I hope this video was helpful. If it was, leave me a comment. Let me know if there's anything else you'd like to know about, or if you want to know how to do this as an investment standpoint, something called Sub 2. We can talk about that as well. So hope you guys have a great day, and we'll see you later. Bye.